For this first session of the afternoon, it's going to be something of a tag team between Fergal Toomey, who is the chief scientist and co-founder of Corvil, and Andrew Rossiter, who is global head of information technology at ADS Securities. And the subject of their conversation this afternoon will be all around latency and its role in FX trading strategies, the monitoring of latency, the measuring of it. Why does it occur? Where does it occur? How does it impact you? What can you do about it? So without further ado, I will hand over to Fergal and Andrew. Thank you.
Okay, thank you very much, Mike. Let's jump to the first slide. So as Mike mentioned, I'm Fergal Toomey. I'm chief scientist with Corvil. And we're a provider of streaming analytics solutions that help our users to monitor activity and performance in complex trading environments. And with me I have Andrew Rossiter from ADS Securities. Andrew, would you like to introduce ADS?
Yeah, so we work very closely with Corvil, we're obviously a client of theirs. ADS Securities is a Middle Eastern firm headquartered in Abu Dhabi. We're quite unusual in that we have a big capitalization. We have $400 million behind the venture. We build all our own technology in multiple areas. And we'll discuss, I don't want to plug ADS too much, we want to talk more about latency, but we'll discuss why ADS is working with Corvil and why latency is important to us. So I think it's my... So we have, one of the platforms we have is a cross-asset platform that we launched about a year ago, API trading. We've added, just in the last month, a new UI to the front end. And it's been built from the ground up. It's all our technology. It's the first kind of trading platform like this to come from the Middle East. The team is very international. A lot of us come from tier 1 banks, multiple asset classes. So my background, for 4 years, I ran the Barks platform for futures, options, and equities. And we've built this platform from the beginning to be a low latency trading platform in all asset classes. We have the platform in multiple locations, Tokyo, London, and New York. We invest very heavily in technology, so all our infrastructure is pretty much state of the art when I talk to the guys that have supplied it to us. And we're fast growing. We keep every month we seem to have another record month in volumes. And the key to our success, I think, is the focus and the money that we're spending on the core engine of this platform.
Okay, thank you, Andrew. So obviously Corvil is fairly widely deployed, widely known and used within the equity markets as well. And in recent years, we've seen increasing take-up for the type of solutions that we provide within FX, which is an interesting development. Obviously, the equity markets were earlier to turn to large-scale electronic trading, and so issues of performance and latency have been important there for a long time. And now we're starting to see some of those same issues start to become more important within the FX sector as well. And that really reflects the increasing use of electronic trading within the FX sector. So most surveys of activity, market structure within FX trading nowadays reveal that electronic trading is actually the preferred execution channel across most sectors of the market. Certainly within spot FX, for example, FX options, any of the less complex FX derivatives. Electronic trading has now become the dominant way in which people trade. It's not quite yet reaching the same levels of market penetration that we've seen before in the equity space, but it's starting to get there. And so surveys also reveal that the same benefits that were seen before within the equity space are now being seen within FX. So greater liquidity, there's a more diverse marketplace, there are more platforms where you can trade, It's easier to access prime brokerage services. And there are new types of participants in the marketplace, smaller banks, hedge funds, and also high-frequency traders. And I think we also start to see some of the same concerns that people express about electronic trading in equities starting to emerge also within the FX market space. So those would include concerns about latency. Are we fast enough? Are we exposed to latency risk or latency arbitrage? Can other players in the market pick off our trades because they have better technology than we do? They're faster. And so the response of participants in the market to those questions, I think there's two main types of responses that we see. One of those is around, let's make sure that our systems are optimized for speed. Let's invest in technology, make sure we're the fastest, and nobody else can get ahead of us. The other response is to try to seek, if you like, a fair playing field where latency doesn't necessarily give participants in the marketplace an advantage. And so that's what you can see in places like PowerFX, for example, where they deliberately delay orders from some of their trading participants in order to remove latency advantage. Andrew, I know that you have massive experience within the equity space. You're really a veteran of electronic trading within equities, and now you work in the FX space. So I think your views on the parallels and the challenges that I've seen in both spaces are absolutely fascinating.
Yeah, so I think this is an interesting slide. Before, I had a background in FX before I moved into equities, but when I arrived at ADS, I thought it would be a fairly simple problem to solve. But actually, I think the FX pricing environment is far more complex than equities. So the difference really is in equities, in general, there's just one venue. That's not always true, but in general, there's one venue, but there's a lot of pricing that comes from one venue. In FX, you've got far more venues, you've got a lower level of pricing, but you've got far more venues to deal with. And that gives a completely different problem to solve. And when you're talking about monitoring latency, it's a completely different problem to solve. So even on latency, a lot of people when they talk about latency, they talk about order latency, which for me is completely irrelevant. Order latency is not the question to be talking about, or the subject to be talking about. Price latency is the key to having a successful system. And the reason for that is that in the FX market, if you're an aggregator and you're seeking out the best prices, you've got a lot of different venues to aggregate very quickly. You may not be sending all of those prices, you're only sending the best bids and offers to another venue, so you've got 95% of the pricing that you receive, you're throwing away. So to measure the latency of the 5% that you're sending to the client is a complex problem. It sounds very trivial, but it's actually a complex problem. And if you're, like we do, we create synthetic prices. So in the larger price bands, 5 million, 10 million, we're creating a VWAP price. And that VWAP price may come from 10 liquidity providers to give a very tight spread in a large band. So again, if you're monitoring latency, I send one price to the client, but actually it's made up of 10 prices behind it. So how do I monitor latency in that environment? Now, the reason that price latency is so important is it gives you more time to execute the order. So every millisecond that I spend and waste in sending a price to a client is a millisecond I can't use for my smart order router to work. So if I can knock 50 milliseconds off the price, the time it takes for me to send a price to a client, that's actually 50 milliseconds I have extra to play with. And the reason for that is because the LP has got a timer, the liquidity provider has got a timer running. They sent that price, X number of milliseconds later, it's going to go stale. So as soon as they've sent it to me, my clock is running. And I have to have extremely low latency pricing. So then I can give my algo that's going to go and sweep the market or build this 10 million fill enough time to execute. And given that I may be aggregating across 50 LPs, I may hit 10 LPs, some of them are going to reject. I need time to resend my order to liquidity providers. So monitoring all of that, you have to monitor it. I mean, I'd be interested if there are aggregators around that don't monitor their latency. But actually monitoring it is a complex problem. And there's quite a lot of data that needs to be stored and monitored to do that. Fergal mentions the technology arms race and the cost. I have a slightly different view of that which we discussed, which I think actually the cost to becoming a liquidity provider is coming right down. I mean, some of the offers, we've built our own market making platform, but in the process we were offered platforms, and I was amazed at how low some of the vendors would go to provide that. So I think the barriers to entry to be a liquidity provider are coming down. So I would see that as expanding the market. And we're continually talking to new sources of liquidity, the people, companies that haven't announced that they're entering the market. So, but the cost of aggregating all that data and providing one marketplace is going up. That's to me where the arms race is in the aggregation and being able to see the full market. And that's why, come back to it again, but that's why the price latency is so important.
Yeah. Let's just jump ahead. Obviously, the focus of the session is on the role of monitoring and in how monitoring can help to address some of these strategic challenges that we see. So if we look at the issue of latency, obviously getting data about latency within the environment, it helps you to optimize your systems first of all, so that's important. Find the bottlenecks, make them faster. It also plays a role in positioning what you do. So if you have good data about how fast you are, that can be, that's often a selling point for your platform, or a way to differentiate the strategy that you're proposing to use. So understanding the impact of latency on strategy success is quite an important strategic goal of monitoring. So the way that we in Corvil, and obviously ADS, they're a customer of ours, they're using the Corvil monitoring system, but the way in which we monitor some of these factors is basically by tapping into network data within the trading environment. So our system is designed to be completely non-intrusive. We don't integrate with the trading platform itself. We simply plug into the network that the trading system is using to communicate with the outside world. And we decode all of the information that we see there, and we timestamp it very accurately at the point where we first observe it. And then we correlate all the different messages that we see within the environment in order to produce latency measurements. So the advantage of doing things that way is basically you can tap into your infrastructure at the very edge where your infrastructure connects to your clients or connects to your service providers, your trading platform, your liquidity providers. And you can measure latency at those points to get, between those points, to get a complete end-to-end view of latency across your system. So Andrew brought up the issue of pricing latency, and there's no doubt that pricing latency is a particularly complex form of transformation that occurs within aggregators specifically, where pricing data from liquidity providers is ultimately transformed into some kind of quote that is displayed to trading clients, and that transformation process can be quite complex. So within our platform over the years, we've built in quite a lot of intelligence, quite a lot of smarts in terms of the different ways in which we are able to correlate messages. We can correlate messages based on arbitrary identifiers that we plug out, based on trading information, symbols, prices, trader IDs, and we can also correlate messages based on external data that we pick up. So if there's external data flowing somewhere within the trading platform that identifies which client quote was triggered by which liquidity provider quote, we can use that to correlate those messages and produce a latency measurement. Nevertheless, we have definitely learned by working with Andrew and ADS that the FX environments definitely are quite complex. I think there's quite a number of challenges that we've had to overcome working there. So surprisingly enough, although the equity space obviously is a lot more mature in terms of use of electronic trading, the FX space is actually quite a good deal more complex in the way that it operates.
Mm-hmm. And there's just picking up from that, just to complement Corvil. We've got a couple of very quick early wins So we monitor our liquidity providers, and a huge tier 1 liquidity provider, we said there was latency on the line, which we could detect using Corvil. And they said, okay, no problem, we'll upgrade, we'll double the link size and we'll upgrade and it'll be ready on Monday morning. Monday morning we looked, and looking at the microbursts, we could see that they were still maxing out the line to us. And so, we complained, and they said, okay, yeah, we didn't do it, we'll do it next weekend. They doubled the size of the line. This time we said, yes, we can see it. And it completely reduced the latency in the platform. And not to keep going on about it, but the latency, it's extremely subtle problem, because a slow LP can actually disrupt your pricing because they are slow. And you kind of need all of your liquidity providers to be at a very similar speed. And the reason for that is, if you can imagine, if the market moves, I've got my prices from my 4 liquidity providers, they move down, this liquidity provider is slow, suddenly he becomes the best price when he didn't mean to be. And if we then try and hit that liquidity provider, it's rejected because it's a stale quote, because he has then seen that the market has moved. We try and hit his price. So if we have a slow liquidity provider in the mix and we don't monitor that, that affects all of our pricing. The second thing we found with using the Corvil tool, again to discuss the subtlety of latency, is the client actually has a very big impact on latency, and latency on your system. So if they can't consume the prices quickly enough, it will back up the line and it will introduce latency into your trading platform. And we could see, for instance, a big bank that we provide pricing to, they had a slow consumer problem. So we were sending so much data to them that they were not consuming it quickly enough. And we could monitor that in the Corvil platform. We could actually see the size of their buffer, and we could see them struggling to pull everything off the network and process it. So there's 2 things. One, that means that even though we had a really fast system, it sat in their buffer, it's already become stale because they can't process it. And we pointed that out to them. But also, because it backed up the line, it started to affect our pricing. And so, with this tool, we were able to then discuss with the client maybe reducing the amount of data they took. They were using a third-party platform, so they couldn't do much about their code, or increasing the line size. So there's just a couple of examples where you wouldn't imagine latency to be an issue. It's not even on our platform, it's someone else's platform that's causing it, and this tool allows you to monitor that. And that's, you owe me a beer for that one.
I owe you a beer, Andrew. Thank you very much. It's certainly true that latency, at the end of the day, it can arise in many different ways, and it often arises from complex interactions from different components within the trading environment, and also from different layers, the application layer, the network layer, etc. And so having visibility into all of those is important for dealing with latency. I'm not saying that you have to use Corvil to get that visibility, but you definitely need that level of visibility. I think one thing that I'd like to ask the audience, actually, how many of you who work in with electronic trading specifically believe that you have sufficient visibility into latency to make you comfortable or confident today? There's one. Very good. The other way around, how many of you worry about latency blind spots, or whether latency could be affecting your platform or your trading strategy? I think it's because the industry is so highly distributed, so highly interconnected. It's really very, very difficult to get visibility into every possible source of latency within the environment. And the ability to monitor latency side by side with how your trading processes are doing, how successful you're being, it's really the first step, I guess, in trying to identify whether latency is affecting you. But if it is affecting you, then actually nailing down precisely where the latency is coming in can be quite a tricky technical problem.
Excellent. Thanks, gents. That's a really interesting discussion. Are there any questions from the audience about what has been discussed so far? Okay, well, I have a question. You talk about monitoring network latency and being able to detect, where the points are, where things are backing up and so on. How much visibility can you get, or do you need to get into kind of more granular kind of aspects of latency, looking into the application itself, so beyond the network, and how do you deal with that?
This is for Corvil specifically?
For Corvil,
Yeah.
and is that an issue for ADS? I mean, do you need to go beyond that?
Okay, I'll go first. So network latency is one aspect of latency. Obviously, network latency itself comes in different forms as well: distance latency, queuing latency, but you often find that the larger component of latency is actually coming at the application level. So in terms of application processing, the various transformations that messages go through within these trading environments. So how do you get insight into that? Obviously, given that Corvil, our solution, the way that we specifically work is by tapping into the network. It's probably not obvious immediately that we can provide visibility into application layer latency as well. But in fact, we can, and the way that we do it is by, first of all, decoding all of the information that we see at the network level to identify the application messages. So we're basically monitoring the messages going in and out of the various application layer processing components. And then we're matching up those inputs and outputs based on various identifiers that we can see within the messages or that we pick up from other message streams. And so we're able to identify which message was triggered by which other message, and therefore to tell you what the latency was. And significantly, we can do that in a very unambiguous way because we're monitoring at the input and output points, and we're taking the data off the network at those points and getting very accurate network level timestamps for those inputs and outputs. We're able to generate very accurate measurements. Whereas if you try to do the same thing within the application process itself, you run into a lot of technical difficulties around process scheduling, the accuracy of software timestamps. It ends up actually being quite difficult to do.
Yeah, I think that's a key thing, actually. One of the reasons I wanted Corvil was the transparency. I often have discussions with my developers, and where they, if we're trying to do latency measurement by the developers, they always write to the logs in the most opportune time so that they miss out large chunks of latency. So there are things you can do in the application, like actually as the message passes through, each process can, even though it hasn't gone on the network, you can stamp your message with, a time, even though, it's not, quite as accurate as the Corvil appliance, but you can still millisecond timing and below on your object as it goes through the system, and then when it goes out on the network, then that can be picked up by Corvil. So you can still, within a process, stamp your message and then it being picked up. The other thing is, you mentioned queuing. And queuing is the death of a system. So maybe you can survive a little bit of queuing, but as soon as I hear the word queue, that's it. It's over. The system is not performing. And monitoring the application, and that's obviously where most of the queuing happens. Can it pull the data off the network fast enough? We invest in 40 gigabit networks. State-of-the-art switches. It's phenomenally quick, the infrastructure that we deploy onto. But at the application, can it process that data quickly enough? And that's obviously a key area that you need to invest in.
Okay. Any questions from the audience? Yes, Hendrik.
On the timestamps again.
Sorry, we have a microphone.
Thank you. Yeah, Hendrik Klein, DaVinci West. On the timestamps, the operating system, sometimes they don't have the level down to the last microseconds, or even, how do you do that to compare the timestamps?
So the way that we do it, our timestamps have nanosecond granularity. So they're made in hardware based on network packets arriving at a particular point in the network. So they have nanosecond granularity. If you're looking at something like, if you're looking at the latency between events that are measured by the same device, time-stamped on the same clock, that means you can get latency measurements with accuracy in the range of perhaps tens of nanoseconds. So it's extremely accurate when you're using the same clock. Of course, when you're timestamping events in different places, different sites perhaps, or even different companies, and trying to compare those timestamps, then the accuracy of the results that you get will depend on how well synchronized the clocks are. So there's various different ways of dealing with clock sync. You can synchronize using, there's a range of different technologies that you can use to keep clocks in sync to external time. We support most of the common techniques. We also have a built-in self-synchronizing technology that we use, that we run between our own appliances, so that when we don't have access to accurate external time, we can still measure latency accurately, provided that it's being timestamped by, provided that the timestamps are being made by Corvil.
And we use, within ADS, we use GPS timers throughout the platform, and the times are pretty stable, actually. That's another thing that we monitor. Monitoring your times on each of the servers is part of the latency monitoring issue, and everything is GPS synced. So yes, within an application, obviously there's going to be a bit of variance because your CPU and everything is in play. But when you're talking about the application, I'm not so worried about nanoseconds. I'm more worried about micro and milli. One developer can write two completely different bits of code, but at the network level, it's extremely accurate.
Excellent. Well, I think that's probably all we've got time for. So, Fergal and Andrew, thank you very much for your
Thank you very much.
participation. Thank you.
I should mention, there's ADS Securities do have a stand here, so if you'd like to find out more about what we're doing together, we will be there for a while. We're also running a raffle for an iPad mini, so if you'd like to drop by and leave your business card in the bowl, we'll send you some more information about Corvil, but we'll also put you in with a chance to win the iPad mini. So
Excellent.
do that if you get a chance. Thank you very much.
Okay, thanks, gents.
Thank you.